Good morning. Welcome to Kenya News Update today. I'm your host. In a story that reads like a corporate thriller, the Directorate of Criminal Investigations has just unraveled a sophisticated internal fraud scheme. Four trusted employees allegedly exploited their positions to steal and launder a staggering 31 million shillings from their employer. The details, revealed in a DCI statement on Monday, February 23, 2026, paint a picture of calculated betrayal. Today, we take a deep dive into how this 31 million shilling heist was allegedly pulled off, the methods used to launder the money, and what this case reveals about the vulnerabilities within Kenyan businesses. We'll examine the breakdown of the stolen funds, the timeline of the scheme, and speak to experts on corporate governance and financial crime. This is a 12-minute investigation into trust, greed, and the systems designed to stop them. Our story begins with a company, which the DCI has not yet publicly named, operating in Kenya. Within its finance or procurement department, four individuals held positions of significant trust. They had access to company funds, approval systems, and vendor networks. According to the DCI, this access was the key they turned to unlock a fortune. The total amount siphoned off, as meticulously tracked by investigators, is 31,053,520 shillings. That's not a round number, it's a precise figure indicating a forensic audit trail. The scheme wasn't a one-time smash and grab. It was a sustained, multi-layered operation that allegedly ran for a significant period, methodically bleeding the company dry. Let's break down that massive figure. The DCI's investigation points to several distinct fraudulent methods being used in tandem. The first and largest chunk involves fabricated invoices and phantom vendors. Investigators allege the employees created false companies or inflated invoices from real suppliers, then approved the payments themselves. The funds, once released by the company, would be funneled into accounts they controlled. This method alone is believed to account for approximately 28 million shillings of the total theft. That's over 90% of the entire haul. The second method involved direct cash theft and manipulation of petty cash or emergency funds, amounting to roughly 3 million shillings. Finally, smaller, more direct transfers or unauthorized salary bonuses made up the remaining 500,000 shillings or so. This breakdown shows a scheme that was both bold in its large-scale fraud and meticulous in covering smaller tracks. But stealing the money was only half the battle. The real challenge, and the part that often trips up criminals, is laundering it, making dirty money look clean. This is where the investigation gets particularly interesting. The DCI statement suggests the four didn't just stash cash in a mattress. They allegedly engaged in a classic layering process. Initial deposits were made into multiple bank accounts, some in their own names, others in the names of accomplices or shell companies. From there, the money was moved. It was transferred between accounts, converted into mobile money, perhaps through services like M-Pesa, and then used for conspicuous consumption. Investigators are tracing purchases of high-value assets, land, vehicles, and luxury goods. The goal was to create a complex web of transactions, so tangled that the origin of the funds became obscured. However, financial forensic experts say this very activity creates a digital footprint that is hard to erase completely. So, how was the scheme finally uncovered? The DCI hasn't revealed the specific trigger, but experts point to several common red flags. A vigilant internal auditor might have noticed duplicate invoice numbers, vendors with incomplete details, or payments that didn't align with project timelines. Alternatively, a whistleblower within the company, perhaps a colleague who grew suspicious, could have tipped off management. Another possibility is that a bank's anti-money laundering software flagged unusual transaction patterns from the company's accounts or the personal accounts of the suspects. Once management had suspicions, they likely brought in external forensic auditors. These specialists can pore over thousands of transactions to find anomalies. Their report would have formed the basis of the complaint filed with the DCI's Serious Crimes Unit or the Banking Fraud Investigation Department. The DCI's move on Monday, February 23rd, was decisive. All four suspects were arrested. They were then arraigned in court, likely at the Milimani Law Courts in Nairobi, to face charges. The charges would typically include conspiracy to commit a felony, stealing by servant, money laundering, and making false documents. The prosecution will now have to prove beyond reasonable doubt that each individual knowingly participated in the scheme. This is where the DCI's evidence, bank statements, audit reports, witness statements, and possibly communication records, becomes crucial. The suspects have the right to plead not guilty and defend themselves. Their defense attorneys might argue a lack of intent or that their clients were following orders from higher ups, or that the audit findings are flawed. This sets the stage for a potentially lengthy court battle. To understand the broader implications, we need to look at this case from multiple perspectives. First, from the company's viewpoint, this is a devastating blow. The direct loss is 31 million shillings. But the indirect costs are far higher. There's the cost of the investigation and audit, legal fees, potential regulatory fines if internal controls are found lacking, and immense reputational damage. Client and investor trust can evaporate overnight. The company must now overhaul its entire internal control framework, a costly and time-consuming process. For the employees not involved, there's a sense of betrayal and a cloud of suspicion. Morale can plummet. This single incident could threaten the viability of the entire business, especially if it's a small or medium-sized enterprise. From a legal and regulatory perspective, this case is a test. Kenya has robust laws against corruption and economic crime, including the Anti-Corruption and Economic Crimes Act and the Proceeds of Crime and Anti-Money Laundering Act. The Office of the Director of Public Prosecutions and the courts are under pressure to demonstrate that these laws have teeth. A successful prosecution and recovery of the stolen assets would send a strong deterrent message. However, critics argue that the system is often slow, and high-profile cases can drag on for years, allowing suspects to dissipate the stolen funds. The efficiency of this particular prosecution will be closely watched by the business community and international bodies that monitor Kenya's fight against financial crime. Now, let's consider the societal perspective. When 31 million shillings is stolen from a productive business, that's money not being used to pay other employees, not being invested in new equipment, not being paid as taxes to fund public services. It represents a direct drain on the economy. Furthermore, such cases erode the general trust that is essential for commerce. If employees cannot be trusted, and if internal controls are seen as weak, it increases the cost of doing business for everyone. Lenders become more cautious, insurance premiums rise, and investors demand higher returns to compensate for perceived risk. This case, therefore, isn't just about one company, it's about the business environment for all Kenyans. We spoke to a corporate governance expert who asked not to be named due to the ongoing case for insight. This alleged scheme, they said, highlights a catastrophic failure of the 3 lines of defense model. The first line, the employees and managers, was compromised. The second line, risk and compliance oversight, was either absent or ignored. The third line, internal audit, either failed to detect the fraud or was prevented from doing its job. The key lesson for all companies, big and small, is segregation of duties. No single person should control all aspects of a financial transaction. The person who creates a purchase order should not be the one who approves the invoice for payment, and that person should certainly not be the one authorizing the bank transfer. It's basic, but it's often the first control to break down in fast-growing or understaffed companies. A financial forensic analyst we contacted emphasized the human element. Fraud of this scale is rarely just about greed, they noted. There's often a perceived pressure or incentive. Maybe the employees felt underpaid or unfairly treated. Maybe they saw lavish spending by executives and felt entitled. Or perhaps there was a simple opportunity. They realized the controls were weak and thought they'd never get caught. This is why a strong ethical culture, set from the very top, is as important as any software control. Employees need to know that unethical behavior will be caught and will have severe consequences, but they also need to feel valued and fairly compensated to reduce the motivation to steal in the first place. Looking at the timeline, the scheme's duration is telling. If it lasted for months or even years, it suggests a deep-rooted problem within the company's oversight. How many quarterly reports were signed off? How many board meetings were held without this massive leak being detected? This points to potential complicity or negligence at higher management or board levels. The board of directors has a fiduciary duty to safeguard company assets. If they failed to ensure adequate internal controls, they could face legal action from shareholders. This case may yet have ramifications that reach the highest levels of the company's leadership. In contrast, let's look at a different kind of financial challenge facing the region, as reported by The Guardian Africa. While this fraud case involves the illicit movement of millions, other crises involve the desperate need for funds for public health. The Guardian reports on a huge vaccination drive in Malawi after a polio outbreak, an effort hampered by aid cuts. They note an astonishing 1.3 million children were targeted in the campaign. This juxtaposition is stark. In one scenario, individuals allegedly conspire to divert 31 million shillings for personal gain. In another, health workers struggle to find resources to protect 1.3 million children from a paralyzing disease. both stories in their own way are about the flow of money and its profound impact on human well-being. Back to our main story. What happens next? The four suspects are out on bail or remanded in custody as their case proceeds. The DCI and the prosecution will continue to gather evidence, possibly seeking to trace and freeze more assets. The company is undoubtedly working with insurers, though many policies have exclusions for internal fraud. The recovery of the stolen 31 million shillings is a priority, but it's often a difficult process. Assets may have been sold, money spent, or moved out of the country. Even if the suspects are convicted, the company may only recover a fraction of its loss. This is why prevention is infinitely more valuable than cure. So, what can other businesses learn? First, regular and surprise audits are essential. Second, implement strong digital controls within accounting software, with clear user permissions and audit logs. Third, promote a speak-up culture where employees can report suspicions anonymously without fear of retaliation. Fourth, conduct thorough background checks on employees in sensitive positions and rotate duties periodically. And fifth, invest in fraud awareness training for all staff so they can recognize the red flags. The cost of these measures is a fraction of the potential loss from a single major fraud. In conclusion, the alleged theft of 31 million shillings by four employees is more than a crime story. It is a case study in organizational vulnerability. It exposes how trust, when not backed by rigorous systems, can be weaponized. It shows how the methods of money laundering have evolved in the digital age. And it tests Kenya's institutional capacity to investigate, prosecute, and deter sophisticated economic crime. As the court case unfolds, it will provide answers, but also raise deeper questions about corporate ethics, regulatory enforcement, and the social contract within Kenyan workplaces. The ultimate cost of this 31 million shilling scheme will be tallied not just in shillings, but in broken trust and missed opportunities, a loss that far exceeds the monetary figure. For Kenya News Update today, this has been a deep dive investigation. Subscribe to Kenya News Update today for more in-depth reporting.